Hey everyone, who is here? Tell me who is on the webinar. Looks like we have about 10 people who are already on the call. Let me know where you're from. Hey Scott, nice to see you. Who else do we got? Let me know where you're from. Hi Meredith. Hi Cheyenne from Houston. Hey Zander. Zander's going to be performing a song for us today. You've got your drum set, you got your piano. Except, I love it.
It's where I take out my frustration on life is my drum set.
I love it.
My brother got all the guitar talent in the family. Hey, you look nice. Look at you all dressed up.
Thank you. I know. You know, it's like the mullet, right? Party on the top, or business on the top and party on the bottom.
That's pretty much everyone from the Midwest, right?
Yes.
Yes.
Exactly.
Yes.
Yeah, and today I'm doing my webinar from our bathroom. Yeah, because Jay's in our studio. So yeah, and I've got this other room that I normally do this in, but my dog is like a maniac today. So this is like 2 doors away from the dog. So I'm in my bathroom today, guys.
Awesome. Hold on one second.
Hey Chris. How's it going, Donna? Hey Michelle. Who else is here? Raise your hand if you're here. Why don't you tell me, we asked this question last time. Why don't you tell me how many rolls of toilet paper you got?
About 78.
We actually bought some for the first time in a month. We were at Target yesterday, so it was pretty exciting to see that Target finally has toilet paper again.
I know. The real essentials, things you cannot go without.
Yeah, exactly. Hey Lee. Yeah, I was just at your house. Less than 20. Show us your stock since you're in the bathroom. Yeah, that's great. I will do that. Yeah, so if you stick around to the end, we'll do a special sneak preview of my toilet paper. Yeah, well, it's 3:01, so let's get started. I know people are going to jump in. Since we do have a little bit of a smaller group, happy to answer questions along the way. So feel free to use that chat box on the right-hand side there. Put your questions in there. I'll be monitoring it. And, you know, if you have any burning questions, definitely let us know. So I am going to share my screen. And then I'm going to introduce myself and our special guest today. So today we're going to be talking about buying your first investment property, but we're also going to be doing a deep dive into what's going on in the market in terms of loans and things like that. Zander and I had an opportunity to do this class a couple weeks ago, and I'm just curious to chat with him and find out what's changed in the past 2 weeks since everything's so volatile. But before we do that, my name is Wendy Papasan. I run the Papasan Properties Group here at Keller Williams. Our hub is in Austin, and we've got locations in Dallas, Houston, Texas, and Minneapolis, Minnesota. Jay is not going to be joining us today. He had another engagement. But some of you know him. He's the Vice President of Learning at KWI and author of The Millionaire Real Estate Investor. And together we have, through you know, fits and starts, we've been investors for about 16 years in the Austin market. And, you know, it's really one of the things I'm passionate about. I love helping people build wealth through real estate, and I love talking about money. I love talking about wealth building, and so hopefully we can do a little of that today. But before we do that, I want to introduce Zander Blunt, who is our preferred partner at Prime Lending. So why don't you just tell us a little bit about yourself, Zander?
Thanks for having me, Wendy. I love doing these with you. I always learn a lot, and I hope you guys too. as well. I got in the mortgage business in 2001, right after the first rate drop in a highly unregulated market when I was living in Philadelphia. I shortly moved to New York after that, where there were truck drivers quitting their jobs to originate loans because it was pretty easy at the time. There was no regulation, and that's what kind of where we got into some problems. So then we had the crash in 2008. I moved back to Austin by then and joined Prime in 2005. And we've seen every kind of market since then. And this is reminiscent of 2008 when we saw a major liquidity crunch, but that was a different type of fallout where we just lost trust in the banking system and didn't know how to value an asset. This is an external force nobody's come across in our generation. And it's had a similar impact on the markets, but how we recover is going to be a little bit different. The stock market went from 29,000 to 21,000, just like that. And it's kind of found its way back in the middle. So we're still lending money. We're still very busy, but how we're doing our jobs has changed quite a bit over the last few weeks, and not just working from home, but how we're getting loans closed, how we're pre-approving new buyers, how we're handling refinancing, and how we're working with people that may be temporarily unemployed, how we can get them the money they need. So I look forward to chatting about all that.
Oh, well, let's just start there. I mean, obviously 21 million people have applied for unemployment, right?
Yep.
For a lot of them, hopefully it's going to be a semi-temporary situation, right? So tell us kind of, what you're doing with that. And if people do want to get, because people are still moving, they got to maybe move across the country for a job or a divorce or whatever that looks like. How are you handling that?
Well, the guidelines are still very clear. You have to have a job. If you're a W-2 salary job and you're not currently working, you can't get a loan.
Okay.
If you're self-employed, you can still get a loan, but they are going to look at year-to-date P&Ls and balance sheets, and it has to be a reasonable decline. And you have to show that if you operate a business like a hair salon, when you're going to be opening again.
Okay.
You can't close the loan until the business is open again. So it's a little trickier if you're self-employed.
Okay.
Because you're legally not allowed to work, but as soon as you can work again, then you can get a loan, and the same qualifications are still going to apply. We are checking on verifications of employment verbally with the borrower on the day of funding on a purchase, where we call them to confirm they are still employed.
Okay.
That used to be a written verification through a third party, and it didn't have to come to the client. So the agencies have passed some more strict things in some regards, and they've loosened things in others, where we always had to have a bank statement in a PDF showing your name and account number. Now they're allowing screenshots temporarily. So they've backed off on some things, but appraisals are still happening. They're taking 2 to 3 weeks on a new purchase, but we're also seeing a huge uptick in appraisal waivers, which is called a property inspection waiver. And that's when you go under contract and we run the loan through Fannie and Freddie's automated system, and it generates a property inspection waiver. We don't need to even get an appraisal on the property. That means we can close financing in 3 weeks instead of 4 to 6 weeks, which depending on how long it takes to get appraisals done. So we used to get a property inspection waiver maybe on 1 out of every 20 deals. Now it's about 30 to 40%. So we're running it through Fannie and Freddie to see which one likes it better. Their rates are the same. Their guidelines are nearly identical. And then it's something we can also do while you're in the option period or whether before you're even under contract to know how long. If you need to get really aggressive to close in 3 weeks and we know we don't need an appraisal, then that's a pretty good tool to have in your bag.
That's awesome. So what's going on? I know last we talked, jumbo loans were kind of going out the window. What is going on with jumbo?
They have officially hit the ground face first since then. They were out the window and now it's gone splat. So it's pretty ugly. I won't lie there. We are still lending jumbo money. We're down to 2 investors instead of 9. Mm. We had, I think, 5 last month when we did this. And it's got to be right down the middle of the road. So any jumbo loan is any loan over $510,400. You need 20% down minimum. 720 plus FICOs, and your debt to income ratio cannot exceed 43% on a fixed rate or 40% on an ARM. But the rates are, you're dealing with only 7 and 10-1 ARMs. They're in the high threes, still not bad. Any fixed rate, you're starting in the mid fours.
Okay.
And for comparison, 6 weeks ago, a jumbo 30-year fixed was 3.25.
Wow.
Chase has priced themselves out of the market. So if you pull a quote with Chase, it's going to show to lock in a rate at 4.5, you need to pay 6 discount points, or about $68,000 to lock in that rate. So they're basically saying, we don't want your loans.
Right.
Wells did it a different way. Wells just said, we're not offering this product right now. Check back in 6 months. So we still are lending.
Wells is a little bit more honest than Chase right now, right?
Yeah, which is weird to say.
Yeah.
But we, our bank, Plains Capital, has a $5 billion warehouse line. So we have our own in-house products of jumbo ARMs that we're lending on pretty confidently. That's not going to go away. The deal just has to be pretty strong. You're not seeing any of the deals that had sub 700 FICOs, DTI up to 50, LTVs over 80. Those are gone and are going to be gone for at least, I'd say, 3 months, probably more like 6 months. But the way this market works is once liquidity returns, there is demand for these loans as long as they know they can sell them. They just don't want to sit on them and service them. So as soon as that comes back, the rates are going to come back down substantially. And from the market call we had this morning with our lock desk that talks to all of our investors, rates are going to remain low, not only through 2020, but through 2021, because this is going to be a long-term economic slump we're going to try to get out of here. And the number one tool the Fed has always used to stimulate the economy is housing.
Absolutely.
And to get people buying, or they have to incentivize them in the form of lower interest rates. Now, I just pulled a quote for say you wanted to buy a single family investment property here in Austin. Mm-hmm. You need 25% down. So it's a bigger down payment. And the rate is around 4.5. That rate was 3.875-4%. So it's about a 50 basis point spread. That's where our rates were 2 years ago.
Right, exactly.
So,
it's still historically low.
And there may be more deals. You can speak to this, Wendy, but there may be some actual value and opportunity in this market where you suddenly have a lot of fear. You've got people suddenly listing houses that they need their equity out of because they can't refinance or they have to sell. Yeah. And demand is coming from interesting places. We're still seeing the random multiple offer with 8 offers and it goes in a day that are properties priced well. There's still demand there.
Sure. Yeah. Well, there's less houses that are being listed and there's less buyers, but if there's less houses being listed, there's the market is still in play.
Yep. Yeah. So on an investment, so for example, on that deal for an interest rate at 4.5, and it only costs a quarter discount point to buy down to 4%. So for an extra $800, you can get the rate down a half point. So the yield spreads between the rates aren't making a lot of sense right now. So the banks are content to let you buy down the rate for a very reasonable cost. So let's say at 4%, that payment on a $300,000 loan is $1,430. So you factor in taxes and insurance, you're probably around $2,000, $2,200. Mm-hmm. You could probably cash flow on that house, rent it for $2,500, or at least break even, and the value of that house is going to continue to appreciate. The long-term forecasts that we're seeing from Austin, if we set aside our current issues, are still as strong as any city in the country.
Of course. Yeah. Well, we still have people moving here. I mean, what's happening is, we do a lot of relocation, and what's happening is that's stalled a little bit, because if you've got your whole company working from home, there's really no reason for you to relocate to Austin at this moment when you can work from your home for now. And so some of that relocation, I think the pause button is on there, but it's going to probably flood back a bit.
Yeah, we do a lot of relocation lending, especially in Dallas, where we're headquartered for AT&T and some big corporate players. And it's definitely down about 30%. Mm-hmm. And I think this whole pandemic has just forced people and companies to reevaluate how they can work and from where.
Sure.
I'm certainly not as productive working at home with a 7, 5, and a 2-year-old. I'm lucky to be able to work. And, you know, 2 of my processors have worked remotely for us for 5 years. And, you know, this is nothing new to them.
It's all very situational. I mean, I think what we'll see is a lot more companies rotating people in. You know, maybe, you know, the marketing team comes in on Tuesdays and they're working on Tuesdays and Thursdays. And then you've got the finance team that's there on Wednesday and, you know, maybe utilizing some of that space, you know, just cutting off a space and things like that. So we'll see what happens.
Yep.
It'll be fascinating.
So unemployment numbers were announced today. Another 4.5 million.
Yeah. It was like 22 million now or something.
26 million total.
26 million. Wow.
So unprecedented numbers that we have just never seen on this scale before. There are a ton of people at work, and as you probably read yesterday, Congress is passing another infusion to the SBA and PPG.
Right.
And it's a big game of politics as to who's getting that money. I mean, as you've seen, there's been big corporations lining up for a handout that shouldn't be getting it, and the small businesses are still not getting the money they need. It's certainly going to help, but you know, as you read in the news here in Austin, you're seeing restaurants and bars go out of business every day.
Yeah.
So that money can't come soon enough. So what people are, you know, a lot of people that do own homes, their biggest nest egg is the equity in their house. So we're seeing a lot of home equity line of credit, second liens. We're seeing a lot of refinancing to get money out of their home. But those cash out refi rates are, you know, we're doing some of those at a higher rate than they're currently at, but they need the money.
Right.
You know? The cash out, any adjustment to a regular middle of the road loan, whether it's a cash out or an investment, you're seeing a pretty good adjustment to the rate to offset the added risk on those loans. But if you look at the rates where we are now, even with those adjustments, historically, they are still very low, very competitive, very affordable.
Oh, sure.
Especially
when we bought our first house, our very first house, it was 7.25. This was in 2001, and we thought it was pretty good.
Yeah.
Which is hard to believe, you know.
Probably still cash flow just fine on that.
Well, we lived in it, so yeah, it was fine, and we still got it as a rental property. Obviously, we've refinanced a lot since then, but yeah, historically low rates. So what are those rates on the HELOC and the cash out?
A HELOC's going to be around prime plus 1. So prime is 3.25, and HELOC rate will be around 4.25. So, and those are interest only. So you're paying, you know, anywhere from $300 to $700 usually on a HELOC. It's not a big payment. It's affordable. Problem with interest-only loans, as we know, is people don't pay down the principal unless they're forced. So it's not something you really want to have to rely on or hold very long. And then when things come back, we tend to pay off a lot of home equity loans and first liens and roll them into all a fixed rate.
Okay, great. Well, I'd love to dig into that a little bit more when we talk about how to finance your investment property, but let's scoot here. Yep. So thank you for that great market overview. And Zander's going to jump in since I lost my partner in crime today with Jay. And then can you see the questions? Because for some reason, I'm not able to look at the questions. Are you able to look at that chat box?
Yes, I can.
Okay. I noticed a couple people posted a couple questions.
Okay, cool. Let's check them out.
Yeah.
Scott Sutherland. Federal moratorium on evictions for properties. Okay, definition of a Fannie Freddie backed mortgage. So any conventional loan.
Can you read the question?
Yeah, sorry, Zander. There's a federal moratorium on evictions for properties with Freddie and Fannie backed mortgages. What's the definition of a Freddie Fannie backed mortgage? Do conventional loans fit the criteria, or just FHA and commercial loans issued directly by Fannie Freddie? Very good question. There's a couple different things there to address. Any conventional loan that is not going to the FHA or VA program, so government-backed loans, do not fall within Fannie Freddie. That would be Ginnie Mae, so the government servicing entity. So there's two government servicing entities. The primary ones are Freddie and Fannie. And when you do any conventional 30-year fixed rate, that is going into a pool of loans serviced by one of those two banks. And we use all of their underwriting guidelines. And they are basically the backstop for funding all the conventional loans in the country. Now, the mechanics get very complex once you follow the money to how that trickles down between the GSEs, the loan servicers, the banks and brokers, and the borrower. And whenever there's a liquidity crunch, it disrupts the whole system. So what the FHFA did yesterday was say that the GSEs will backstop loans in forbearance. But if you read the fine print, it was very narrow window of when you had to have a forbearance. It's only for literally loans up until May 1st that you have already had one. And then the cost for us to sell that loan is about $10,000 on a $200,000 loan. So there's no profit in it. So what the Fed announced to help people effectively is not going to save anything or save anyone. It's true that nobody can be evicted right now. A lot of lenders are allowing loans to go into forbearance. We still highly recommend not doing that if you have any ability to avoid it, because it's going to show up on your credit report and you're not going to qualify for a loan. They don't report you as a short sale or a foreclosure, but it still impacts your credit and makes it hard to get a loan. So try to find any way around doing a forbearance if needed. And then is how it fits commercial loans. Commercial loans don't have anything to do with Fannie or Freddie. That's all residential. The SBA and PPP was designed specifically for business loans and commercial loans.
Awesome. Thank you. Well, so we're just going to talk about a couple things. We're going to do an investing 101 for those of you that are pretty new to investing. And then we're going to just talk about some opportunities in a changing market. And obviously neither of us have a crystal ball, but it might be fun just to spitball a little bit. And we'd love some engagement from those of you out there about potential opportunities that you think might come about. So I know for me personally in 2007, I really didn't have any cash to do any investing. I had 2 young children and I was a stay-at-home mom, and we were living off my husband's salary. And I came across a lot of opportunities that I wish I'd been able to take advantage of in the last recession. And, like Warren Buffett says, we want to be fearful when others are greedy, and we want to be greedy when others are fearful. And right now, there's a lot of fear out there. And fear does create opportunity. And I think there is going to be a lot of opportunity in probably 6 to 8 months, 26 million people unemployed. That means there's going to be some trickle down into the housing market. There's going to be opportunities to probably purchase businesses. And I personally think there's going to be a lot of opportunity in the commercial real estate space, because as these businesses go out of business, and honestly, a lot of them are never going to come back. I was reading an article in the New York Times yesterday, which basically spelled the doom of the kind of major, like Macy's,
major retailers.
The major retailers like Macy's, they're all on pretty thin margins anyway. The majority of their sales were from their physical space. They hadn't migrated to the online space. 90% of their sales are in shopping malls or whatever that looks like. And Lord & Taylor just filed for bankruptcy. And so a lot of that kind of retail, that's in commercial space, restaurants, things like that, are going to go out of business, which is going to mean they're not going to be able to pay their rent. And for a lot of these commercial landlords who don't have kind of big pockets, they are going to have to sell those buildings, right?
Yep.
So personally, I think there's going to be a lot of opportunity in the commercial space, but probably residential as well. So here's the reality though, guys, is only 1 in 3 Americans has any money saved for retirement. That means less than 56% of Americans have less than $10,000 saved for retirement. And investment, even one investment property can be sort of a game changer for you and your family. I tell the folks on my real estate team, if you were to help 10 families a year over the course of a 10-year real estate career, you could significantly change the lives of 100 families. So by owning one additional just one rental property. Really, you could pay for someone to go to college. You could pay for increased care when you're elderly. And real estate's, it's not that liquid. It's not that easy to sell, unlike stocks where you can literally push a button and sell all your stocks. Real estate is just a little trickier to sell. And therefore, in a way, it can be a great investment for you because you got to hold on to it, right? So it's tricky to sell. So, what does wealthy mean? Wealthy is really when your money works for you instead of you working for your money. And how do you become wealthy? Wealthy is, the best way to become wealthy is to acquire assets. And if you think about it, Zander, the list of Forbes richest 500 people, they have that list every year. All of the people on that list, they're not, the richest mortgage broker. They're not the richest real estate agent. They're not the richest doctor, and they're not the richest lawyer. They have assets, right? And typically they own, a lot of them own commercial real estate, honestly, yep. And they own businesses. And so that's what we're talking about here, is acquiring real wealth through businesses in real estate.
Yeah.
Yep. Okay, so I love this graphic. One of my mentors, Gary Keller, is really good at taking complex things and creating a model and making it simple for people. And so I love to share this path of money, because to me, especially if you're a newbie to investing and you're a newbie to money, this path of money really makes everything quite simple. And so this is a graphic that he created for a class he taught a long time ago. He still teaches it, called Quantum Leap. But there's just really two kinds of capital in the world. And one is human capital, which is you work for the money. So if I mow lawns for a living, right? If I go out and I'm pushing that lawnmower around your front yard, that's human capital. If I don't push that lawnmower around, I don't make any money. And then we have capital assets, which is where money works for you. So if I decide I want to turn my lawn mowing business into an actual business, and I want to hire people to do that work for me, and I'm the one who takes the phone calls and passes it off to somebody else, that means I've got a business, and that's a capital asset. And really, there's just, they both put off cash flow, right? So they both create money. So whether you're doing the work yourself or whether you've got a business that works for you, it's putting off money. And then there's just 4 choices for the cash flow. So it's spend it. Obviously, we all know how to do that. Donate it, which is great, especially now. Hold it, right? Mattress money, and then invest it. And that's what we're talking about today. And really, those investments can be broken down into a couple of things. One is you either lend the money out, right? So you're lending it to someone and they're doing something with it and you get a return on that, or you own stuff. You either own businesses or parts of businesses, or you own real estate. And there's just 2 options there, and that's passive and active, lending and owning. And so if you look at the left side of this chart, right, you've got passive lending, and those are the things that are going to be very, very safe, right? So I don't know what kind of rate you can get on a CD right now?
1%.
1%. Yeah, it's pretty low, especially if you think about inflation, which is going to be like typically 2 to 3%. And same with government bonds, right? There's probably no way if you bought a CD or a treasury bond that you're not going to get paid, right? It's a very safe investment. But the return on it is really low. And also you can't really do anything to make that investment better.
The 10-year treasury yield today is 0.52%, so 0.5%. And in Europe, they gladly settle for negative yields on some of their bonds. So,
wow. Yeah, it's like buying a barrel of oil.
Yeah.
Yeah.
We've got an oil tanker we can borrow for a year.
I know, right? Make some money, if only, right? If only. Yeah. And so then you've got passive owning, right? Which is stocks. I think everybody knows what stocks are, but stocks are essentially a piece of a business. And we tend to get a better return on the stock market. So not necessarily recently, although we're back up to where we were about 6 weeks ago is when the market started to get all jinky. But typically you get an 8% return on stocks over time. And then you've got mutual funds, which is a bunch of stocks, pieces of stock all bundled together, right? And that kind of spreads the risk out for you. So you're not just investing in one company, like you're not just investing in Apple, but your mutual fund might have pieces of companies, or, different companies that they're invested in. And then you've got REITs, which is kind of like a real estate mutual fund. Again, there's not much you can do to change it, make the return better. Even if you bought, even if you had a lot of money and you bought 1,000, a million iPads, you're not really going to change the price of Apple stock. However, like I said, the return is definitely better. So a lot better than that kind of passive lending. And then you've got active lending, which is, I guess if you're doing passive lending, essentially what you're doing is you're giving money to the bank and then they're loaning it out, right? Yep. For a higher percentage. Yeah. And then active lending is really you're the lender, right? So that would be owner financing if you own a property, and instead of so then you become the lender on a property that you sell. And then you've got hard money lending. And in Austin right now, owner financing could be anywhere from 10 to 12%, sometimes even less. Hard money is a little bit more than that, 12, 15%, something like that. But I've seen it a lot higher in the past. Sometimes hard money is up to 20%. It could be like a credit card.
Yep, and a lot of points to get the money. But for people that don't want to deal with banking and it's a flip, they just factor that into their net on the flip and they still make money on it. So there's always going to be a place for hard money and owner financing.
For sure.
Not ideal. You don't want to have to do it.
Yeah. Yeah. Well, yeah. Well, you're a conventional lender, so of course you'd say that, right?
4.5%, 18%.
No, I hear you. And sometimes you can lend money out to just to help your friends start a business. Like we did a hard money loan for some friends of ours who started a small business. They needed $42,000. They offered us a 18% rate of return in 8 months, and we ended up making about $50,000. We ended up making about $8,000 on it, so that was great. So if you have money, you can lend it out, especially now. But it's definitely riskier, right? So if you're doing a hard money loan on real estate, then you've got at least that real estate that can secure it. But if you kind of do what we did, it can be a little riskier. And then you've got that far right, which is active owning, which is businesses in real estate. And that's honestly where the best return is going to be. A great real estate business, you can make up to, Jay, my husband, and Gary wrote a book called The Millionaire Real Estate Agent. And they talk about owning a real estate business and making a 40% profit. So if you compare that to passive lending, where you're making, 0.5 on the treasury or 1% on the CDs, it's obviously a lot different. And then real estate too, obviously the return on real estate, depending on where you are, can be really significant.
Wendy, I have a question for you.
Yeah.
Because when we quote purchases that have mortgage insurance,
mm-hmm.
and when they put 5, 10, or 15% down and the mortgage insurance doesn't go away until you have 20% equity, we've always used the rule of thumb on an average property in Austin appreciates around 5% per year. So if you put
mm-hmm.
10% down, you need to wait 2 years before MI goes away.
Right.
Is that still a reasonable projection for appreciation? Or do you see that changing over the next few years?
Yeah, so what we've actually, if you look over time, the national average is actually about 6% all over the country. In Austin,
we've had years where it was 10%. Many years.
Yeah, well, in Austin, there's definitely neighborhoods that are double digits year over year. Just depends on where you're at. But yeah, we always, when we do our pro formas, we actually do 6.
Okay.
Because that's what Jace told me is kind of the national average over time is about 6%. And obviously there's fluctuations in the market. It's probably not going to be 6% this year. No. But you know, we don't know.
The good news is that a bad year in Austin is flat. You don't lose value. You don't really lose money in your house.
Yeah. Well, and the other thing that people don't think about, Zander, is when you have an investment property, yes, it's appreciating by 6%, but you have strangers paying your debt down.
Right.
And so that really increases the rate of return. You know, I tell people, hey, if you have kids, you know, you have kids under 5, right? You got a couple kids under 5.
2 of them.
Yeah, and if you were to buy an investment property right now and put it on a 15-year note, you could pay for college 20 cents on the dollar.
Right.
Right. So if you put 20% down or 25%, then complete strangers are going to pay the 75% of that debt off for you.
I've got I only have one investment property, and it was the house that my girlfriend lived in at the time in college at UT in 1997. I met her in an accounting class, and her dad, who lived in Houston, had bought a house in Hyde Park for $150,000 in 95, fixed it up a little bit. Nothing. It was an old, you know, it was one of those old 1920s, you know, beautiful old properties, but it needed some work.
Right.
He brought it to rent out to his son and daughter who went to UT, and I met Ashley, and we moved in it. And then after we moved back from New York, we bought it from them in 2009 for $380,000, and now it's worth about $650,000, and it's a 1,300 square foot craftsman bungalow.
Yeah.
So over the years, that mortgage that I paid down is now down, you know, under 100,000. Well,
right.
And I've been short-term renting it. I generally encourage long-term leases for most first-time investors, but Austin, we'll see how Airbnb is empty, right? And nobody's booking anything, but
yeah,
it is for the right properties and the person who has the appetite for it, the short-term rental income can be pretty substantial as well. Yeah. But now I have 3 kids now, so I got to buy 2 more investment properties to make your
exactly. Yeah, your first one's all taken care of, right? You got to buy 2. Well, we can help you with that, and this is going to be a good year for it. I can tell you that. Yeah. So let me ask. Ashley's not your wife, though. That was your girlfriend at the time.
No, she's my girlfriend and my wife. We've
been together,
22 years now.
I just wanted to clear that up.
Yeah.
If anybody was wondering if you got the house.
Yeah.
We saw her walk by a second ago.
Yeah, our 2-year-old woke up. He was napping in the casita closet. So, hey, this is what we do now.
I'm in the bathroom. What can I say? Yeah, it's all good. It's all good. Yeah. All right. So we already know this. There's lots of people from all over the country, but Austin real estate's been incredible. And you might not have this same story in your market, and yet for sure in the last 10 years, right, your market's probably increased like ours has. And here's the thing is that, you know, a lot of us out there, we think about our income, and we're trained to think about our income because that's what our parents told us to do. Our parents told us to become a doctor. They told us to become a lawyer. They told us to become a dentist so that we could make a lot of income. But the reality is the real measure is your net worth, right? And your net worth is measured by your assets minus your debt. So your assets are everything you own, and your debt is everything you owe. And if you guys don't track your net worth, if you're not doing that, I highly, highly encourage you to do that, because at the end of the day, and at the end of your life, your net worth is really a lot more than what you make on a daily basis. Because if you earn $100,000 a year and you spend $100,000 a year, you don't really have anything to show for it, right?
And I have a personal financial statement template that's really easy to fill out to calculate that number, and it's interesting. A lot of people don't ever look at that.
They never look at it. No, they think it's all about their income, which is just funny because you literally can spend all your income. And I know when Jay and I first started tracking our net worth was about $2,200, which was great because most Americans are in debt. And yet I thought, gosh, between Jay and I, we've probably been working full time 22 years total together. And here we have $2,200 to show for it. So it's like, wow, 22 years of work. About $100 a year. Yeah. Not a lot. And, you know, I get it. A lot of people are, you know, struggling right now, and to have $22 in the bank, $2,200 in the bank would be a luxury and a privilege. And yet you guys are here to really focus on the big picture, which is really about your assets, right? It's not about what you make every day.
I have many clients that we can do up to 10 conventional loans for any client.
Mm-hmm.
If you get to 10, you join a very select club.
Mm-hmm.
And I think we have almost up to 10 people now. We've got dozens that own 4 to 6 properties, but it's really hard to get up to 10.
Mm-hmm.
And we had a couple go over that number last year. And it's amazing when we do their loans to see they get easier and easier because they have more and more equity. We've already done the loans before. The tricky part is getting the down payment to buy the next house, but they're doing all of them by buying it as a primary residence, staying there 2 years, converting it to an investment, then using the minimum down to buy a new primary, staying there 2 years to avoid the capital gains hit. You can do it over and over and over again if you can convince, you know, your spouse to move again.
I think it's an incredible strategy. I mean, 2 of our best investments have been our homes. You know, we own 3 houses in Barton Hills, which when we first moved here, it was a little bit of the ghetto in South Austin, and now it's turned out to be a great neighborhood. Yeah, it's unbelievable. We've seen our net worth grow just by holding on to both of those properties, and they haven't particularly, I mean, one of them cash flows quite well, but that first one, our very first house, which I'm going to talk about in a little bit, hasn't particularly cash flowed very well. We've really never made a lot of cash, monthly cash from it, and yet we've seen our net worth grow as a result. And here's the reality: is the average homeowner has a net worth of $230,000, and the average renter is about $5,000. Right? So think about it again at the end of your life, right? If you need quality care, if you need to pay for college or something like that, having even one investment property, just one, can significantly change your life. It's huge. You know, I have a friend who's sort of been going through some struggles with her daughter, and she's really needed a lot of cash in order to make her daughter safe, and she had to put her in boarding school and things like that, just things that you never really think about. And she's had to sell some of her assets just to pay for some of these bills, you know, that are up to a couple $100,000. And she's like, you know what, this is why I do it. This is why absolutely I have these investments, because you know, we might need them. We just, you know, bad things happen all the time. Life happens. We can't predict it. And real estate, just even 1 or 2 properties through the course of your life can be huge. So, yeah. So where to start? So if I had to do it all again, I would probably buy a duplex, and I'd rent out one side and I'd live in the other with a roommate. And honestly, if my husband and I had to start all over again, this is probably what we'd do. Obviously, we've got 2 kids now. But, you know, back in the day, we could have easily bought a 3-bedroom, 2-bath duplex on each side and had a roommate, you know, if we were young and in our 20s. So if you look at the math here, you can purchase a duplex, and because it's your primary residence, you can put as little as 3.5% down.
Which it's a little higher now, but still, it doesn't change.
Yeah. Oh, you know what we talked about this time? I meant to change that. And what is that? 10%?
10, yeah.
10%, yeah.
But 5% down on a single unit.
Okay.
Fannie Freddie. FHA is still 3.5%. In any 2-plex, 2 to 4-plex, you're at least 10% down.
Okay. So if you were to buy a single family home, you could put as little as 3.5% down, but for a duplex, it's more like 10%.
Yep.
Yeah, still a lot cheaper than any kind of investment property that you could possibly have. And even at 10% down, you're looking at you know, $22,000. You've still got that monthly mortgage, which is going to be slightly less than that. And so you're probably cash flowing a little bit more because you're putting a bit more money down on this one. And then you've got one side that's rented at $1,250. You've got a roommate that's paying $625, which is actually $1,875. So your cash flow would be $275 here. Mm-hmm. And then the reality is when you move out, you're going to cash flow even more. So even if you're not cash flowing right away, someone else is still helping you pay your mortgage down. Whereas if you were living by yourself, you're going to have to pay all that. So it's called house hacking. You know, if you listen to Bigger Pockets, which is one of my favorite podcasts, they talk about house hacking a lot. And it's just a really great way to get started.
What is it called? Bigger Pockets?
Bigger Pockets podcast. Yeah, really good.
All right, I'll check it out.
Yeah. And then there's lots of ways to pay for it. So I always get a lot of questions about how to pay for things. And, obviously, if you can qualify for a conventional mortgage, that's awesome. And Zander can help you with that. However, you can pull out money from another investment that you have. Some of the first investments that we did, we had a partner who loaned us some of the money, or they loaned us the down payment, and we did the sweat equity. So a couple of our very first investments, we had partners. We did the sweat equity until we got to a 50-50 partnership. You can get a hard money lender, which is probably not the best option. It's typically hard to make those numbers work. You can downsize your living situation and use the extra cash to save money for a down payment. I had a woman on my real estate team who was paying about $1,700 to live in a furnished apartment in downtown Austin. And she said, Wendy, I really want to be able to purchase a house, but I don't know how I can do it. And so we looked at her budget, and typically the average American, about 50% of their budget is going to be their living situation and their commuting costs. So like their car, gas, insurance, all of that. And that's a huge chunk, right? So if you want to save money, you want to look at those two things. Can I downsize my living situation and make it cheaper? Can I downsize my car? Can I move closer so I don't have to spend so much money in gas? And she was able to move out of her furnished apartment in downtown Austin into a living situation with two other women. And her rent went from $1,700 a month to $600 a month. So she's able to save $1,100. I think you know her, Zander, Abby Phillips. And yeah. And within a year, she was buying a house.
Yep.
It was unbelievable. It was awesome.
She just got married.
I know. Yeah. So I love that, because most of us don't think that way. Most of us think like we are where we are. We don't want the pain of moving. And yet 50% of a typical American's budget is their housing and their commuting, right? So that's just the easiest way. Like I've never really been someone who's going to like pinch pennies. You know, I like to go out to eat and I like to have a cocktail every once in a while. For me, it just made a lot more sense to cut that big chunk out.
Right.
Or just, again, like we said, buy an investment as your primary residence and only put down 3.5%. You can always get a side hustle, right? Uber, Favor, rent out a room, right? Airbnb.
Zoom speaker.
What's that?
Zoom speaker.
Say that one more time.
To do paid speaking through Zoom.
Oh yeah, Zoom speaker. Exactly. Yeah. Is that a thing?
Yeah. Oh yeah. There's people getting hired for hosting, like taking their act online now. So.
Wow. Yeah. Yeah. All kinds of crazy stuff. Yeah. There's always ways to make money. You know, my husband and I, we always had a side hustle. Before we had kids, I would edit, people's work on the side. He would edit books. And that is actually how we bought a lot of our first investment properties, was we lived on what we made and then we had a side hustle. I'm in real estate now, which is sell a couple more homes and that's your side hustle. But if you've just got a kind of 9-to-5 job, there's lots and lots of ways to make money out there. Or you could sell stuff, right? A lot of us are looking at the stuff inside our house. I know I personally don't want to wear anything that's uncomfortable ever again. I only want to wear comfortable clothes. And I'm putting all my uncomfortable stuff in the giveaway pile. So this is kind of what Zander and I have been talking about this whole time. This is our very first house. This is in Zilker. It looks like a dump, but it's actually a really cute house. This is just a bad photo that was in the listing. And so we put 3.5% down on this baby. It was about $6,000. We lived in it for 3 years. We've had tenants paying down the mortgage for 13 years now. We owe about $115,000 and it's worth $525,000. So ostensibly, we turned $6,000 into $410,000 in 16 years. And that sounds kind of like the experience you had with your Hyde Park house.
Yeah, the math, the appreciation is undeniable. The key is just getting it, doing it, finding a way to make it happen. And it's no different buying a primary versus investment. It's credit, income, and assets. So the main hurdle for buying investment is the down payment. Well, right now, you can raid your 401k tax-free. You can get all the money out of your 401k right now. It's a great time to do it, especially if the market's down.
Oh.
You're not going to need that money for a while. I would argue that investing in Austin real estate could be as good or better performance in the stock market over the next 5-10 years.
Mm-hmm.
So there's your down payment money. Go raid your 401k, then call me, then we'll call Wendy.
I did not advocate, for the record, rating your 401k, but if you've got all of your, I do advocate actually in times like this to be diversified. So we have a lot of money in the stock market. We have a lot of money in Austin real estate. My husband and I own multiple businesses. And in a situation like this, where the kind of this global pandemic, that makes me feel good because I've kind of got my bases covered. Okay, so here's our strategy. Again, this is just what we've done. It doesn't mean it's right or wrong, but we've always focused on long-term buy and hold. I get that some people like to flip homes. To me, that's never made a lot of sense. Almost every flipper that I've ever seen, they put a lot of their own sweat equity in there, and they never take into account how much time that they're spending. And it just seems like they never make that much money. However, that's our market, so you might be in a market that's different. Our strategy is areas outside the central core with good schools. That just makes sense. It's great for resale. You can always sell the house like that. We like a 3-bedroom, 2-bath. In Austin, the property taxes are crazy, so I always buy it on just a little. If I can get a house on a little lot, I mean, why not? I save money on my taxes. And then never buy a house that's perfect. We want to buy a house that has some cosmetic work, has a newer roof, and a newer AC and a water heater. Because I know in Austin, we use our air conditioners a lot. So, and that's going to be about $6,000 to $7,000. A roof is also going to be $6,000 to $7,000, and then a water heater is also kind of pricey. So, are you looking at those questions for me?
Yep.
Okay, great. So now I just want to talk a little bit about potential opportunities that we might see. I know that you were in business during the last recession. Did you see a lot of REOs and short sales? I know in Austin there weren't, but obviously Prime is nationwide. So
yeah, most of that happened in California, Florida, Nevada, Michigan, Arizona.
mm-hmm.
People complain about Texas's strict home equity laws, but it saves you times like this where you can never take out more than 80% of the value of your house. Well, in California, you could take out 125% up until 2008, which is just a scary idea. So if you've maxed out beyond the equity of your house and you're on an interest-only ARM, not paying down the principal, and then the ARM resets, there's no way to avoid foreclosure.
Right.
None of those options are available anymore. So what we're just now getting out of that 7-year window where people that had foreclosure can now buy again.
Right.
A lot of those, if you start foreclosure in 2008, 2009, it's not clearing on the books till 2011. It takes a few years.
Right.
We're just now getting people that are like have their lives back together again. Short sales less. I believe it's 3 years on a short sale.
Mm-hmm.
And forbearance is going to be a shorter window, but it's something you obviously want to avoid, but sometimes you don't have you don't have any other option. So you got to rent for a while.
So what do you think? I mean, obviously this is not a housing recession. Like the last recession we were in was a housing recession. So what is kind of your predictions in terms of the housing market and opportunities? Just let's say residential real estate.
Well, let's see. We're down 15% in year-over-year sales based on the numbers that came down today. Mm-hmm. I think you're going to see Texas is particularly susceptible to oil and gas business. Obviously, right. That's been whacked.
Right.
We've never seen oil go negative. We don't even know how to process that whole
I
notion.
know, I know. I read that. I just didn't even know what to think about it.
That's going to trickle down, and really that will have some impact on Dallas and Houston and San Antonio and Austin, and especially West Texas. But they've had a massive boom out there for so long that I think we're going to see some slow growth. What it's going to create is going to create some opportunity from people that do have cash and can finance. You're going to see some deals. You're not going to get rich off real estate in the next 2 years, but if you buy something now and you hold it for 5, 7, or 10 years, you're going to see some serious appreciation.
Yeah.
But,
well, and at the end of the day, the market always makes any move we make smart, 10 years in the future, right? So like to think about turning a property and making a profit in a year in real estate is it's folly, really. It's pretending you know what the future is, but the market makes anybody who's interested in buying real estate smart in 7-9 years, which is the typical time that somebody owns a property.
And even before COVID in the fall, I started hearing a lot of feedback it seemed like everybody and their cousin was flipping properties and doing these detached site condos and central infill stuff. And the margins got smaller and smaller as land prices went up, cost of construction went up. Your margins were down to hardly anything. So one of the silver linings of something like this is that it shakes a lot of the BS out of the market where people are trying to get in and get out, make a quick buck.
Yeah.
Because people want to buy a property that's nice and they don't have to do the work. Well, you're going to make a lot more money if you buy a property that needs to be fixed up. We lend you the money on a renovation loan to do it yourself. You get the sweat equity, and you get the short-term benefit and the long-term gain from doing that yourself.
Oh, I agree. Yeah, I love that. That's good advice. Well, so here's some books I recommend. I don't know what the return on investment of a book is, but I personally have gotten a massive return on some of the books I've read over the years. If you think about it, you buy a book for $15, what do you learn from that? So those 5 books on the outside are all some of my favorites. Obviously, my husband's a co-author of the Millionaire Real Estate Investor. It's pretty tactical. Rich Dad, Poor Dad is a mindset book on real estate investing. It's not going to give you any tips or tricks on how to do it, but it'll get you in the right mindset around it. And he talks a lot about this idea of net worth and how important that is. Set for Life is one of my faves. So if you're brand new to real estate investing, it's a really nice primer on wealth building. I highly recommend it to everyone. It's just very accessible for everyone. Think and Grow Rich is written over 100 and some years ago. It's still awesome. Book on mindset, Bigger Pockets we talked about. It's a real estate investing and wealth building podcast. So none of us are really listening to podcasts while we're driving around anymore, but hopefully on our walks outside. And then Wealth Can't Wait is another primer on wealth building. So highly recommend all of those. You guys probably have a little extra time on your hands right now, so definitely check some of them out. So here's kind of what we're doing, my husband and I, in terms of, Zander mentioned before how important it is to get our cash together. And I think for all of you that are listening, you guys need to have your cash ready to go. And so what that looks like for a lot of us is just cutting expenses, right? Even if we're doing okay right now, why not cut some of our personal expenses in order to save for opportunities that are going to be coming down, coming down later in 2020. And then you also want to think about your investment criteria. So are you going to buy a duplex? Are you going to buy a single family home? Are you thinking about commercial investing? Are you thinking about maybe buying a business? Maybe you're a restaurant owner and you've got enough money to float you for the next 6 months. And you feel confident that you're going to come back. Well, are there going to be opportunities out there to grow, to acquire talent, right? To grow your business, get another location, whatever that looks like. And we need cash to do that. So first stage is just really get ready, which is the planning. And then this is something that we talked about last time, Zander, which is like, let's get pre-qualified right now, right? If you're thinking about buying, you might as well go through that pre-qual process. Get your cash together. If you're going to do a cash out refi, now is a really good time to do it, or at least start to get prepared for it. Same with the home equity line of credit, because as we know, interest rates, they're probably not going to go up, but they're definitely not going to go down. I don't think between now and next year. There's nowhere to go. They're already so low.
You're not going to get much. The banks, you're seeing about a 250 to 350 basis point spread between rates. You know, the Fed can drive rates to zero, but the banks are still going to lend to make money, right? So that's why you're seeing a standard 30-year fix today is right at 3.5% on a single family home. That is incredibly cheap, low rate. 15 years down to 2.99. It got down to 2.5. 30-year got down to 3. So what we're seeing is basically about a 50 basis point swing, and that's due to the added risk in the market, not because treasury indexes have gone up. They've gone down, but we're not tracking the normal indexes anymore. We're following totally different. We're basically, the Fed is the only buyer right now. They're providing $15 billion of liquidity into the market every day, into mortgage-backed securities and another big chunk into bonds to prop up the market, and they will continue to do that as long as they need to. Yeah. But we don't see rates getting much lower than where they're at now. No. We had about a 10-day window in the end of February, early March. We've done a ton of refinancing, and if you're really lucky if you got in that window, because they don't last long. But if we hung around in the mid-3s for a while, that is incredibly cheap money. Incredibly cheap. If you look at over the course of time with factoring inflation, that's like almost free money. So we're happy to run any pre-approvals if anybody wants to see if they qualify. Really, the biggest determination of your rate is always going to be your credit score. And there's all these free apps available now to check your scores, but people love telling me how great their credit is. Mm-hmm. They're like, they stalk it, they're proud of it. I got an 810, my wife's 808, I'm higher. The women usually have higher credit than men, by the way. But then we go to pull it and it's 740 or 750, or you think you got a 720 and it's 680, 690. And here's why. The apps that are pulling those scores are using soft scores and soft data. They're not getting the hard data from a hard pull, which you always want to avoid a hard pull because it will lower your score a little bit. But lenders have to do a hard pull because we get all the data. And there's 3 bureaus for a reason, because they all have different risk metrics to determine your FICO scores. So we toss out the high and the low score, and we take your middle score. And oftentimes that middle score is 30 to 40 points lower than what your app is telling you. So we recommend that before you apply for a loan, you have your credit card balances paid down at least below 30% of the drawn amount, ideally below 15. It's okay to leave a small balance on a card. It actually helps you a little bit. And we also recommend, I'll throw this out there, is pay your credit cards 10 days before your statements due. Because the credit card companies report to the bureau once a month. Mm-hmm. And their little trick is they love reporting it 7 to 10 days before your statements due. So if you're the type that always pays your credit card bill every month and you're proud of it, it always looks like you're carrying a balance based on what they're reporting to the bureaus. So don't pay your credit cards on the day your payments due. Pay it 7 days earlier and your credit's going to go up 20 to 30 points.
I love that. Well, and so if you pull your credit now, theoretically, right, you can kind of tee yourself up for improving your credit score in the future if you know what you're looking at, right?
Yeah, we can fix things on credit pretty quickly. And there's a great company we work with in Dallas that takes on some bigger cases for us. But your credit score, I mean, we're a debt-based society. It is incredibly important, and nobody teaches you how they work. So a lot of what we do with first-time buyers is explain FICO scores, explain debt to income ratios, and explain how all that all works together. But the number one thing that I try to find is, credit works in 20-point FICO tiers. So 680 to 700, 700, 720. Every 20-point bucket you get higher, you're getting an eighth to a quarter better in rate. Especially right now, you really want good credit. You're going to get hammered on your rate if you've got credit in the low to mid 600s. You're going to pay for it in your rate because it's a much higher risk loan right now.
That's great. Yeah, so get all that taken care of, and then really you want to just take action. The reality is we never know when the bottom is, right? Like if anybody had said, hey, let's predict the bottom of the stock market for the next 6 weeks ago, there's no way anyone would have predicted that, whatever it was, end of March or whatever was the low. And interest rates matter. Interest rates are going to stay low, and there's lots of good deals in any market. So if you're thinking about investing, I would highly recommend that you think about it now, because we are actually seeing a few good deals right now. So I had a gal on my real estate team. She's young. She's in her early 20s, and she was able to buy a house that 2 months ago would have had multiple offers on. She bought it FHA, 3.5% down, and her seller was able to pay about $6,000 in closing costs, which is kind of unheard of at that $200,000 price point in Austin. And yet she was able to do that because everything else that's going on. So just take action, and just know that the market makes you look good in the future. And also just remember that if you're buying an investment property, complete strangers are paying 80% or 75% of your debt off in the future, which is super powerful. And then you can always invest in other cities. So we have an investor network of folks that are investor specialists in other cities. And if you're interested in that, just shoot us an email at office@papasanproperties.com. And what did I miss, Zander?
Well, you always attract an international audience. I think the last call we had someone from Portugal, someone from Indonesia. While we don't lend internationally, we do lend nationally, and we're in every state. I can lend in about 35 states based on our licensing exemptions, being part of a state chartered bank here in Texas. Mm-hmm. So anybody across the country can reach out to us for guidance on whether we should do the loan in their market, or whether we can put them in touch with one of our branches or someone on your team. But we want to help everybody across the country, not just in Austin. So feel free to shoot me an email, text for any lending or financing related question or real estate. We're happy to help.
Yeah, awesome. Well, does anybody have any questions? I know we're kind of at our hour mark, but if anybody has any questions, feel free.
Sarah has a question. How can I easily get my credit score? Not all credit reports show the actual score. In order to get, you can go to myfreecreditreport.com. It sounds like one of those terrible scams, but it's actually a legitimate service that gives you, you can register and get one free report. If you're just doing it for the purpose of checking credit, then I would use a service like that. You can sign up for an account with Experian or TransUnion or Equifax to get their one score. But if you have good credit, a lender pulling your credit report is only going to affect you by about 3 points. And you're protected within a 30-day window of multiple lenders pulling if you want to shop for the loan. If we all pull the credit within 30 days, it's going to count as one hard inquiry. And it's not going to hurt your scores that much. So I would reach out, and we can take a loan application and do a full credit check, because we want to know everything on there. And there's people that the biggest bugaboo on credit is by far collections. Verizon, healthcare are the biggest ones. Even on things that you paid, they still file a collection. You didn't know about it. Often you don't find out that's on there until you have a hard pull. Those soft scores or Credit Karma, those apps are not going to show a collection on there. So you really want to have a pre-approval done and a full credit report looked at least 3 months before you're planning on buying. But we do them for clients that may be a year out, and then they don't end up waiting a year. They end up buying something in a few months or 6 months.
All right, so we got a couple questions. I tried this a few years ago, but properties are gobbled up by cash buyers before properties even hit the market because they knew someone. Can your group help me get an investment, flip/rental with just 20% down? I feel like the cash buyers own the market. Could you address this, please? Well, I think you need to have relationships, right? So obviously, if you're just hopping on Zillow and trying to find a good deal, you're probably not going to find one. But having a good relationship, probably not with just one real estate agent, but probably with multiple realtors is actually a really good thing, because good deals do come across my desk, and I'm going to pass them off to folks who I have a relationship with. So that would be my recommendation, is get into relationships with people who have deals crossing their desk. Yeah, so feel free to reach out to me, because we do have that. We do these webinars, we have investor happy hours, and all sorts of folks come to those investor happy hours. Reach out to, build your network. you know, who are people who are coming across those things. Hey, Ami's got a question. Hey, Ami, if you had money to buy an investment property, but you would still be renting your primary residence, would you recommend instead buying a primary instead? So I think what I hear you saying is that you're renting right now and you have money to buy an investment. Okay, yeah, you're renting right now. Yeah, I mean, what I would do is, yeah, I'd buy a primary.
Buy primary for sure.
Yeah.
And save, do less money down. As long as you've been in your current primary 2 years, use that money to buy a new primary residence at less money down and a much better interest rate. Stay there 2 years, do it again.
Yep, exactly. Yep, that's what we've done. You know that, Ami, you know that house we have in Barton Hills? We bought that for $245, and it's a 4-bedroom, 2-bath, and we've been able to cash flow that really well. And so, yeah, I think it's really smart to buy something to live in. Obviously, if you're worried about, you know, schools or something like that, that's completely different. But
right, we see some obstacles to where you just don't want to sell your current home for whatever reason. That's your home, your dream home. You're going to stay there forever. You're in the right school district. In that case, just wait a little longer till you have that 25% down. We can do loans at 20% down for an investment. The rate's a point higher. It's a significant difference. We highly recommend waiting till you have 25% down, because you're going to cash flow a lot better over the course of that loan, over the course of the loan.
All right, Monica's got a question. If we applied for a mortgage deferral to try and gain cash, should we cancel that or just continue paying our mortgage so it doesn't impact our credit in the long run, or is it too late?
Definitely cancel it.
Yeah.
Definitely cancel it. Don't use that as a mechanism to preserve cash. That has to be a last resort. Do everything you can to pay your mortgage on time, or else it's going to tie your hands on being able to finance anything for a good while.
Yeah. Great. Well, I don't see any other questions. It was always an amazing discussion, Zander. I always learn a ton from you. So thanks for joining us today.
All right.
Yeah, this is fun. Well, this is how I'm keeping up on the market. It's just we do these things every couple of weeks. Guys, stay tuned. We'll do another one.
Yep. So much is changing from month to month now that it's like, hey, it's like starting all over again. So
it's amazing. I love it. Well, and you're always a fountain of knowledge. So I so appreciate you and our partnership. And
me too.
Good to see you. Yeah, and we need to talk about getting you a couple investment properties for those kids of yours, because that's just not fair, you know? One of your kids gets to go to college and the other
just can't do my own loan. So
yeah.
I'll figure that. I'll get a pre-approval from someone else, I guess.
I feel like you've got connections there too. So
we do. All right. Well, we love working with your team. They're amazing. And we've got a couple deals going with Chris right now. And you've got a few new members I look forward to meeting in person next time.
Yeah, I think some of them are on here. So yeah, why don't we have you, we'll have you Zoom into one. We're doing a huddle every morning, so we'll get you on our Zoom here. Yeah.
Sounds good.
Right.
See you guys.
Have the rest of your day.
All right, you too.
Bye.
Bye.